So, bookkeeping is one aspect of starting a business or being a small and medium business owner, especially if you don't have a finance department, where people ask questions as to where do I begin? How do I start? What should I put in place? What system should I run? What files should I have? And in this video, we are going to discuss some of the basic elements or the basic aspects of what you need to set up an effective bookkeeping system as a small, medium-sized business owner or as a new business. Generally speaking, a business without, say, a large finance department that's responsible for bookkeeping, accounting, and finance. So, one of the first things you need to know before you start keeping your books is you are keeping your books primarily for internal and external obligations. Internal obligations meaning you are keeping it for maybe managerial information, you are keeping it for shareholders. Obviously, you need to keep track of what your assets are, what the vehicles are, your payroll, who you are paying, all payments going in and out. And you can also use that to conduct research on, say, what product is selling more. So maybe let's invest more in this product A, product B. And that's an interesting aspect of bookkeeping people sometimes don't realize. You can use that to help improve your business from a managerial tool standpoint. And there's the external obligations, and that deals with meeting your tax obligations, the obligations you owe to maybe the government, etc., etc. Now, for internal obligations, you have more leeway to be flexible with how you conduct things. But for your external obligations, there are laws and rules on what should be where and how things should be conducted. And with that, obviously, you need a qualified accountant and an auditor. Okay, so not to say this is the way, but as a lot of managerial schools teach, there is not always like one route for every business. But there is a way to go about bookkeeping, which is primarily to start from your auditor or the qualified accountant, because they give you a general idea of what you need from a, say, tax obligation standpoint, and from there you can build your system around the tax obligations that are required of you. So they will tell you maybe you need to keep records of your assets, so they'll use that for capital allowance computations. So you likely have your asset file. And for internal obligations, your asset file could be used for investors, say if you are going for a loan, for example. Now, once the accountant gives you an idea of, say, what the tax obligations within the country are, etc., you have a clear idea on what you have to keep records on. But generally speaking, you should keep records of all inflows and outflows. So whatever money or transactions or etc. come in, you keep record of it. Whatever payments etc. are made, you keep record of that. Whatever SNIT payments are made, you keep record of that. Whatever tax payments, just have sheets for that. Some people choose to go for softwares, others choose to use, say, Excel. Some choose to use maybe a more manual approach, which is books and but more or less the general goal of this is to have the information available for interpretation and computation. You usually see, say, a company have, say, a cash book. Some companies just have maybe an Excel sheet where they have the payments and coming in and out, and they separate maybe the payroll from that. Then they have their asset file. And sometimes you just see companies have maybe inflow outflow with descriptions, especially for really small companies. Now, this all works out. What could go wrong is there are times maybe you have someone have a cash book, and in the cash book they think Okay, because debit for maybe a bank account, which is seen as a liability, is money going out, in the cash book, it applies the same thought process. So now they start debiting the money going out of the cash book and crediting the money coming in. And it's not that way. It's supposed to be vice versa. So for a cash book, when money comes in, you debit. When money goes out, you credit. Now, the reason for this point is it's important to not get overly complicated with your fundamental information, because if there's an oversight from, say, maybe the accountant or auditor, and they don't clarify, that's not clarified, there could be issues with, say, preparing your account, or if there is somehow an oversight from the auditor, which is rare that they don't see that, that means your data is totally wrong.